Welcome back to the Top 1% Book Club. You know we love diving into books that can really level up your life, and today we're tackling one that could totally revolutionize the way you think about money.
Oh, yeah. Well, which one?
Benjamin Graham's The Intelligent Investor. Have you heard of it?
Oh, of course. It's like the Bible of value investing, right?
Right. And you know, it even influenced Warren Buffett.
Oh, wow. Really? That's pretty impressive. So what's the secret sauce? Why is this book so timeless? The financial world is constantly changing.
That's the fascinating thing. While markets change, human psychology basically stays the same.
I see.
The intelligent investor cuts through all the noise and really boils it all down to these timeless principles of investing well so you can build wealth responsibly no matter what the market does.
That's really interesting. So what are some of these principles?
Well, one of the most important things Graham talks about is the difference between investment and speculation.
Oh, that's a big one.
Yeah. How can we actually apply that difference to our decisions today?
Well, Graham really wanted to make that distinction very clear, like super clear.
Yeah.
He defined investment as something that's based on thorough analysis and that aims for the safety of your principal and a satisfactory return.
Okay. Makes sense. So how is speculation different?
Speculation is more about like trying to time the market or chase quick profits.
Oh, so trying to outsmart the market.
Exactly. Which, let's face it, rarely ends well.
Definitely. It's like you're left holding the bag when the music stops. So with investing, you're really focusing on the inherent value of what you're buying, right?
Exactly.
But with speculation, it's almost like gambling.
Yeah, it's more like betting on those short-term price movements.
And Graham cautions that speculation can get especially dangerous during market bubbles.
Oh, yeah. We've all seen how that can end. Not pretty.
So how does someone who wants to be an intelligent investor avoid getting caught up in speculation?
That's where one of Graham's most brilliant concepts comes in Mr. Market.
Ugh, yes. Mr. Market. I remember that from the book. Can you remind us about this Mr. Market? What does he represent?
So picture this unpredictable character that shows up at your door every single day, offering to buy or sell you stocks.
Okay.
Sometimes the prices are reasonable, right? They reflect what the business is actually worth. But other days, the offers are totally crazy, driven by fear, greed, whatever, just plain irrationality.
So we shouldn't let Mr. Market's mood swings, dictate our investment decisions.
Exactly. You got it. Don't let his emotions become your emotions.
We need to be more disciplined than that.
Right. An intelligent investor uses Mr. Market instead of the other way around. You can choose when to engage with him and when to ignore him.
I love that. So investing is not just about analyzing numbers, but also about mastering your emotions.
Couldn't have said it better myself. We can't control the market, but we can control how we react to it.
And that's where the margin of safety comes in, right?
Oh, absolutely. One of the most important concepts in the book.
Yeah. Can you remind us what that is again?
So the margin of safety is about buying assets for less than their actual worth.
So you have a built-in buffer.
Exactly. It protects you from the unknown. You know, we all make mistakes sometimes.
And the margin of safety helps protect us from those mistakes.
It also helps protect you from unpredictable things that could impact businesses or, when Mr. Market just goes crazy.
Okay, I see. So it's about minimizing your downside risk, even if it means potentially giving up some upside. Right?
Yeah.
And this reminds me of how Graham talks about the two types of investors, the defensive investor and the enterprising investor. What's the main difference between them?
So the defensive investor, they want to minimize risk. They're content with those steady returns. They're kind of like the tortoise in the race, slow and steady.
So they would favor something like a diversified portfolio, maybe with more bonds.
Yeah, they like bonds for stability. Now, enterprising investors, they're different. They're more willing to put in the time and the effort to find those undervalued opportunities.
They're like the detectives.
Exactly. They might look into things like bargain issues or special situations, like when they see a chance for the market to catch up and recognize the true value of a company.
This is making a lot more sense. So
Yeah.
we've talked about investment versus speculation. We've talked about Mr. Market, margin of safety, defensive versus enterprising investors.
We have.
What else stands out to you about Graham's philosophy?
One thing that's super important is that he was all about taking the long view, you know?
Long-term perspective.
Yeah. He believed that those short-term price changes, those fluctuations, it's all just noise.
Got it.
And that real investors, they focus on the company's performance over the long term.
The long game.
That's how you can really make the most of compounding and build real wealth.
So tune out the daily chatter. Don't get distracted by Mr. Market's moods.
Exactly. Focus on those solid businesses, hold them for the long run.
All right, so we're starting to understand what it takes to be an intelligent investor. But what about actually building that portfolio?
Hmm.
Where do we even begin?
That's a great question, and that's where things get really interesting.
I'm excited to hear more.
Graham has specific advice for both defensive and enterprising investors, covering everything from bonds and stocks to special situations. But before we get into those strategies, remember what we said about taking a balanced approach.
Balanced approach, you mean diversifying our investments?
Yes, but it's more than that. It's
Hmm.
about finding the right mix that works for your specific goals. You know your risk tolerance, the amount of time you have, and it's about sticking to the plan, even when the market is going crazy.
Sticking to your guns.
Exactly.
So it's not about chasing the hottest stock or trying to time the market.
Nope. It's about making informed choices based on those solid principles.
So where should we start when it comes to building that portfolio?
Well, this might surprise you, but Graham spends a lot of time talking about bonds in the book.
Bonds. That's interesting. I thought this was about investing in the stock market.
I know, right? But it goes back to his focus on minimizing risk. He saw those high-quality bonds as crucial for bringing stability to your portfolio. It's a counterweight to the ups and downs of the stock market.
So they might not have the same potential for growth as some stocks, but they offer more stability.
Exactly. They can also give you a steady income stream, with the interest payments,
Uh-huh.
which can be really valuable if you need to supplement your income or if you're just looking for a more conservative approach.
So it's about understanding the role bonds play in the big picture. Okay, now we can't talk about investing without talking about stocks. What are some key things to remember about selecting common stocks?
Let's start with defensive investors. Graham recommended sticking with those large, well-established companies, the ones that have been around a while. They have a solid track record of making money and paying dividends.
Like the blue chip companies.
Exactly. They may not be super exciting, but they're stable.
Okay. So how do we go about evaluating those blue chip stocks?
Graham advises looking at things like the price to earnings ratio, the PE ratio,
Mhm.
to see if the stock is priced fairly compared to its earnings. You can also check out the dividend yield. That tells you how much income you're getting for every dollar you invest.
So lower PE ratio could mean it's undervalued.
Potentially.
Yeah.
And a higher dividend yield could mean more income coming your way.
Right. But it's not just about chasing the lowest PE or the highest yield.
Right. Absolutely. It's important to understand what's behind those numbers. Why is the PE so low? Is it because the company is facing some problems, or is it just overlooked by the market? And is that high dividend yield going to last, or is it a sign that the company might be struggling?
So it's about more than just plugging numbers into a formula.
Exactly. You need to understand the whole story. The company's competitive position, the management team, their long-term potential.
So you're not just trading pieces of paper, you're actually owning part of a business.
That's it.
Now, what about enterprising investors? What's their approach?
So enterprising investors are like those detectives we were talking about before. They're looking for those hidden gems the market might be missing.
I love it.
Graham suggests they look at things like net current asset stocks. These are companies where the market value is less than the net working capital. Basically, you're buying their assets for less than they're worth on paper.
Wow. So what other strategies did Graham recommend?
Well, he also liked looking for special situations. Unique situations where something happens that could unlock hidden value.
Oh, like mergers and acquisitions.
Yes, or spin-offs, or even restructuring.
Sounds like this requires a bit more expertise
Yeah.
and maybe a higher tolerance for risk.
Yes, you are right. But for those who are willing to put in the time and the work, these strategies could lead to much bigger returns.
That's pretty exciting. But even for enterprising investors, those core principles still apply.
Oh, absolutely. Thorough analysis, margin of safety, emotional discipline, those are always important.
This has been incredible so far. We've covered so much already.
I know.
It's amazing to see how these core principles can really help anyone make better financial decisions. What else can we look forward to as we keep exploring the intelligent investor?
Welcome back to our deep dive into the intelligent investor. We're really getting into the nitty-gritty of Benjamin Graham's wisdom and how it can help you make smarter financial decisions.
It's amazing to me how relevant this book still is, even in 2025. In the last part, we talked about the importance of knowing the difference between investment and speculation and the role of Mr. Market.
Right. And don't forget those core principles, margin of safety and emotional discipline.
Yeah, those are really important. We also started talking about some ways to actually build a solid portfolio. Remember, Graham emphasized a balanced approach.
Yes, finding the right mix of investments for you. It's all about your goals and how much risk you're comfortable with.
Totally. And we were kind of surprised that he spent so much time talking about bonds.
It is a bit unexpected in a book about investing, right?
But it makes sense when you think about his emphasis on minimizing risk.
Exactly. Okay, now let's switch gears and dive into stocks.
All right, bring on the stocks.
How do you analyze companies and figure out if they're worth investing in?
Okay, this is where it gets really interesting for me.
I know, right?
I'm ready to put on my business analyst hat and dig into those financial statements. Where do we start?
So Graham was really adamant about looking beyond just the earnings that a company reports. It's not enough to know if a company is profitable. You have to understand the quality of those earnings.
Okay, quality of earnings.
Yeah.
What does that even mean?
It means asking yourself, how did they get those profits? Are they sustainable? Are they coming from real growth in the business? Or is it just some accounting trick or a one-time thing?
Got it. So we have to be a bit skeptical, like a detective.
Exactly. So what are some red flags that might tell you that those earnings aren't as good as they look?
That's a good question.
Well, one thing to watch out for is when companies use a ton of debt to boost their profits quickly. It might look good in the short term, but it can be really risky, especially if interest rates go up or the economy takes a hit.
So basically, too much debt is not a good thing. Makes sense. Are there specific numbers or ratios we should be looking at?
Graham suggests looking at the debt-to-equity ratio. It tells you how much debt a company has compared to its equity. If that ratio is really high, it could be a sign of trouble, especially if the company's profits or cash flow are going down.
Okay, so debt to equity ratio, got it. And this reminds me, Graham also talked a lot about cash flow. Why was that so important to him?
Because cash is king. It's what lets companies pay their bills, invest in growth, and give back to shareholders through dividends.
Right.
Graham was always a bit suspicious of companies that had high earnings but weak cash flow. It could mean they're playing games with their accounting or that there are hidden problems.
So we're looking for companies that are making real money, not just reporting big numbers.
Exactly. We want to see strong earnings, a healthy balance sheet with manageable debt, and good cash flow.
What other things did Graham want us to look at?
Another thing he talked about is working capital. It's basically the difference between a company's current assets, things like cash, inventory, and money they're owed, and their current liabilities, the bills they have to pay soon.
So it's kind of like checking their bank account to make sure they can cover their bills.
Yeah, a healthy working capital means they have enough liquid assets to meet their short-term obligations.
So we're really checking under the hood to make sure everything is running smoothly. It's not just about finding companies with cool products or exciting growth stories.
You got it. You have to understand the fundamentals of the business.
And this is for both defensive and enterprising investors, right?
Absolutely. Even if you're digging for those hidden gems or looking for special situations, you still need to know that the company is financially sound.
It's all starting to click now. We're becoming informed owners, not just gamblers.
I like that. Now let's shift to a topic. Graham was really passionate about shareholder activism.
Oh, interesting. Tell me more.
He believed that investors shouldn't just sit back and watch. We have a voice and we have a responsibility to hold management accountable.
That's pretty powerful. So we're not just looking at numbers on a screen. We're actually taking ownership of our investments.
Exactly. He wanted investors to go to those annual meetings, ask tough questions, and vote on important matters. He even said that investors should be willing to challenge management if they feel things aren't being run properly.
Wow, that's pretty bold, especially back in the 1940s.
Yeah.
How did he think people should do that?
He suggested writing letters to the management team, voicing concerns or making suggestions, and connecting with other shareholders to form a group and have a stronger voice.
So it's about being an active owner. But what if you're not comfortable confronting management?
Well, Graham understood that not everyone wants to be an activist. He said even small things can make a difference, like doing your research and voting your shares carefully.
Makes sense. It's about being informed and engaged, even if you're not leading the charge.
Okay, before we move on, let's talk about a topic that always comes up when we're talking about Graham growth stocks. What was his view on those?
It's a good one. Growth stocks are always tempting, especially now when everyone is looking for the next big thing.
Right, everyone wants to get in early. So he knew that growth stocks had potential, but he also saw how dangerous they could be, especially for defensive investors. He warned people not to overpay for growth just because of hype or speculation, because even the best companies can hit a rough patch.
Yeah, we've all seen those companies that promise the world and then fizzle out.
Exactly. He was basically saying, don't get fooled by unrealistic promises. Focus on value, not just hype.
So how do we know the difference between a real opportunity and a bubble that's about to burst?
That's the million-dollar question. It's not always easy, but Graham gave us some great tools to help us analyze companies and make smarter choices.
Okay, I'm ready for some tools. What should we look for when we're trying to evaluate growth stocks?
Well, he said to look at the company's past growth rate. Is it sustainable? What's the competition like? Is the management team experienced and trustworthy?
So we need to do our homework and look beyond the headlines and the stock price.
You got it. We need to understand the business, its strengths and weaknesses, and its potential for growth in the long term.
Okay, that makes sense. And even with growth companies, the margin of safety is still crucial, right?
Absolutely. You want to buy those stocks at a price that gives you some wiggle room in case things don't go as planned.
I'm seeing how these principles can be applied to so many different investment decisions, whether you're a defensive investor looking for stability or an enterprising investor hunting for bargains.
Exactly. It's all about being an intelligent investor.
We've covered so much in this part,
Mhm.
analyzing financials, understanding growth stocks, shareholder activism. This is amazing. Where do we go from here? Welcome back to the Top 1% Book Club. We're wrapping up our deep dive into Benjamin Graham's The Intelligent Investor. This book is full of wisdom. It's really stood the test of time.
I know, right? It's incredible how relevant his principles are, even in today's crazy market.
In parts 1 and 2, we talked about all those important concepts. Investment versus speculation, Mr. Market, margin of safety, emotional discipline.
Yeah, all that good stuff.
We also started exploring different strategies to analyze companies and build a solid portfolio.
Right, we even put on our business analyst hats. Remember that?
Oh, yeah. But I'm ready to go even deeper. What else can we learn from Graham about building a portfolio that can handle those market ups and downs and help us reach our financial goals?
Well, one of the most valuable insights Graham offers is diversification. He's really big on that.
Diversification. That makes sense.
He basically says you need to spread your investments across different things, different types of assets, different industries, even different parts of the world.
Okay, so don't put all your eggs in one basket, right?
Exactly. By diversifying, you can lower your risk and make your returns more stable over time.
Makes sense.
Yeah.
But how do we know how much to diversify? Is there like a magic number?
Graham doesn't give us a specific formula, but he does suggest that all investors should have a mix of stocks and bonds.
Okay.
The exact mix depends on your risk tolerance, how long you're planning to invest, and what you're hoping to achieve.
So finding that balance between growth and protecting your money.
Exactly. But even within those asset classes, we still need to diversify more, right?
Right. So with stocks, how many different companies should we be looking at?
Graham says to have at least 10, but 20 or more is even better.
Wow, that's a lot.
It sounds like a lot, but it helps to make sure that if one company does poorly, it doesn't tank your whole portfolio. He also recommends diversifying across different industries.
So you're not too exposed to just one sector.
That's the idea. It's about spreading your bets and managing your risk.
And diversification isn't just about how many things you own, right?
You're right. It's also about what kind of companies you choose. Graham suggests having a mix of different types of investments, like large, well-established companies, smaller, faster-growing companies, and maybe some value plays or special situations.
So we're diversifying across different investment styles too.
Exactly. And Graham also talks about the importance of regularly reviewing and rebalancing your portfolio.
Oh yeah, why is that so important?
Well, over time, the market changes. Some investments do better than others, and your original asset allocation might get out of whack.
Things shift around.
Exactly. Rebalancing helps you maintain the right level of risk and keeps you from getting overexposed to any one thing.
So it's not just a set it and forget it kind of thing. We need to stay engaged.
Yes. Monitor your investments and make changes when you need to.
Before we finish up our deep dives, I want to touch on one last thing that Graham talks about a lot, patience and discipline. He reminds us that investing is a marathon, not a sprint.
So true. But it's so hard sometimes.
It's easy to get caught up in all the excitement and make quick decisions, especially when you see other people making money fast.
Graham has some great advice for this. He says to focus on the process, not just the outcome.
Okay.
Stick to your plan, do your research, and don't let fear or greed control you.
So trust the process, even when things are crazy.
Exactly. Remember, time is on your side when it comes to investing. Compounding can really work wonders if you give it time.
Wow, this has been such an eye-opening journey into the intelligent investor. I can see how Graham's principles can really help anyone make smarter money choices no matter how much experience they have.
I totally agree. His wisdom is timeless. There's always something to learn from this book, whether you're just starting out or you're a seasoned investor.
So as we wrap up this deep dive, what are some of the key takeaways our listeners should remember as they go on their own financial journeys?
Okay, let's recap those important lessons. First, always remember the difference between investing and speculating. Investing is about thorough analysis and aiming for safety and reasonable returns. Speculation is about trying to time the market, which often leads to trouble.
It's about building wealth slowly and steadily, not trying to get rich quick.
Exactly. Second, emotional discipline is key. Don't let fear or greed make your decisions. Have a plan and stick to it.
Tune out the noise and focus on what you can control.
Right. Third, never forget about margin of safety. Buy assets for less than they're worth. It's like a safety net for your investments.
It helps you sleep better at night.
Exactly. Fourth, always do your research. Whether you're buying stocks, bonds, real estate, or anything else, understand what you're getting into.
Knowledge is power, especially when it comes to money.
So true. And finally, remember that investing is a long-term game. Be patient, stay disciplined, and let compounding do its work. Build a diversified portfolio that fits your goals and risk tolerance, and don't worry too much about those short-term ups and downs.
These are such powerful lessons. It's not about following the latest trends or trying to outsmart the market. It's about making informed decisions, staying focused on the long term, and building a strong financial foundation for your dreams.
Couldn't have said it better myself. Benjamin Graham's The Intelligent Investor is a must-read for anyone who wants to achieve financial success and build real wealth. It can truly change your life.
Thank you so much for joining us on this deep dive into the world of intelligent investing. We hope you feel empowered to take control of your financial future.
Remember, the path to financial freedom begins with a single step and a commitment to making intelligent decisions.
Until next time, keep learning, keep growing, and keep investing intelligently.